Greetings and welcome back to session 6 of Introduction to Business Finance. Today's topic is on working capital management. As the topic clearly defines, this is the capital that works within the organization. Now, this is different from fixed capital such as buildings, machinery, and equipment. It has more to do with the short-term assets such as inventory, receivables, and cash. Now, this is the nerve center of any business, and in most cases also referred to as the lifeblood of any business. Failure to get it moving will result in the business dying off prematurely. Now, identifying the right balance is critical to the financial success of any firm. This section therefore walks the student through how to be effective and efficient in managing working capital and the relevance of the components within the working capital management trajectory. At the end of this session, students should be able to explain the relevance of efficient working capital management to the well-being of a firm. They should be able to trace what the working capital cycle is, quantify the benefits and costs in terms of working capital management, and be able to execute efficient working capital management in a business setting, i.e. by looking at its inventory, receivables, and cash. Now, the key topics to be covered in the sessions and beyond will look at the overview of working capital management in general and the policies. Then we'll narrow down to look at inventory management, trade credit and payables, and cash and securities management in general. Now, let's look at working capital and its related elements. Now, working capital typically comprises the assets on the balance sheet that have a lifespan of typically 1 year or less. In other words, or in essence, these assets must be converted to cash in 1 year or under. So working capital intrinsically involves the management also of current liabilities, because these are assets belonging to others who show us as liabilities on our financial statements. Now, we could refer to working capital as gross current assets, and this is made up usually of inventory, receivables, cash, and marketable securities. Now, net working capital is usually the difference between what we have as our current assets and what we also have in our books as current liabilities. Now, working capital management therefore involves two basic questions. What is the appropriate amount of current assets, both in total and for each specific account like inventory, cash, and receivables? And how should we finance these? Now, how an organization responds to those questions defined above tells us the working capital policy that is operating within the firm. So, for example, a firm that has a working capital that is looking to having a lot of current assets on hand financed by long-term debt so that it does not run into issues because it wants to take life a bit more slowly, is assumed to have a conservative working capital policy. On the extreme, we have the one that likes to keep the minimum levels that can be attained for all and tries to even fund it with cheaper short-term capital. This is usually one that is pursuing an aggressive working capital policy. And then we have the maturity matching group that tries to find a balance by ensuring that the lifespan of the assets within its capital structure framework is matched by the maturity of the financing. So then, to a large extent, you can determine the kind of policy that is being pursued by a firm based on the volume of inventory, receivables, and cash that it keeps, and whether they finance these with either short-term or long-term funding. So as we've already discussed, the conservative is also sometimes referred to as a relaxed policy. They keep large amounts of cash and inventories, and sales is stimulated using the use of credit, so they have significant receivables, and so then they seek to finance that using long-term funding. On the aggressive group, which is also referred to as a restricted policy, they keep holdings of cash, inventories, and receivables to a minimum, and they try to use a lot of accruals and payables to settle these. The maturity is the middle point between the two extremes. They try to match the assets with the maturity of the financing. Now, what would actually influence the working capital levels of a firm? That could be the nature and size of a business. A typical production firm would have a lot of inventory, whereas an institution or a service firm like a consulting firm may not have a lot of inventory on hand. Now, depending on the production cycle, whether it produces a chunk of its goods sold would also determine how much working capital it would have, specifically the inventory and the cash it wants to keep. How much sales it generates and how much it grows in terms of sales would also influence how much working capital will be. And whether it has a credit policy, and to a large extent who qualifies for credit, would also influence the working capital level. And whether the firm has ease of access to credit, because if it's got ease of access to credit, the temptation is that it may be able to stock on loads of inventory, offer good credit to its clients, and for which reason it would have high levels of working capital. Now, let's move now to the individual components that make up the working capital. We start with inventory management. Now, inventory typically is the stock of goods that a firm trades in. So then, having sufficient inventory will ensure that you do not lose out on sales. However, when you have excess inventory, it means that you would incur higher costs than necessary, both to store them and to insure. Now, when you do have large inventory, but typically made up of wrong items because it's not reflecting the demand you face, there's a high possibility of going out of business because you lose out on sales and a number of the things have to be reduced to clear, and so that results in high financing cost and lost sales. Now, on the other hand as well, inventory management is relevant because inventory management is more closely related to the operations of a firm, and failure to manage that appropriately would mean that the firm could easily go out of business. Now, in managing inventory, your overall goal is to ensure that as much as possible, your total inventory costs are minimized, whilst you maximize customer satisfaction by being able to meet demand. Now, objective therefore is you minimize the level of investment in stock for a given level of cash flow or sales. Now, the practical decisions you must make therefore is establish the quantity of goods you must order at any point in time when you need to place an order, and also based on your demand, be able to establish the point at which you must make the relevant requisitions for which new orders will be delivered. Now, before you proceed with making those decisions, you need to begin to understand the types of inventories you may face. For some, there's inventory of raw materials. Then we also have work in process materials, that means items that are still under production. Then we have inventory of finished goods, and then for certain firms we may have an inventory of maintenance, repair, and operating inventories made up of items used by the firm in servicing its relevant components of machinery, but not necessarily manufactured or sold by the firm. Keeping the relevant quantum of such items is very critical to the success of any business, because every business that is selling something must have the right amount in stock at the right time and in the right quantum in order to be able to generate sales. Now, in carrying inventory, typically there are a number of costs that can be faced. One of them is carrying cost. That is the cost of carrying goods, be it in the warehouse. Now, this has to do with storage and handling, insurance, property tax, depreciation, obsolescence, and pilferage, meaning that when you carry large amounts of inventory, the space for storage and handling would cost money. Buying insurance will cost money because insurance is computed as a percentage of the value of the asset being insured. Property taxes, depreciation, and all. And then also, to have inventory, normally you must place an order. So your ordering cost will look at the cost of placing the order, shipping it, and handling it. Or when it's in-house production, you begin to also add the cost of the production line. Another cost that is relevant but normally not computed in the calculation of the models for inventory levels is a loss of sales, loss of customer goodwill, and the disruption of production schedules. Now, these are normally not quantified but are relevant costs that need to be factored in making decisions on inventory levels. Now, one very common approach to inventory management is what is referred to as the EOQ model. Now, this EOQ model tries to find a balance between ordering costs and storage costs and provides the firm with the most optimal quantity that it should order for at any point in time that will ensure that its total inventory costs are minimized. Now, looking at it closely, it so happens that when a firm buys a lot, in which case it minimizes the number of orders per year, it means that it might have huge space for storage. What that means is that its storage or carrying cost is likely to go up, but its ordering cost is going to be minimized. On the other hand, if it decides to buy very minimal quantities, whilst its storage cost may go down, its ordering cost may go up due to the frequency of ordering smaller quantities to meet its annual demand. Blending these two relationships gives rise to the EOQ model because at that point, ordering costs and carrying costs are equated, they become equal. That is when we attain the minimum total inventory cost, and that gives us the formula EOQ is 2 into the annual demand multiplied by the carrying cost, the cost of order, divided by the carrying cost or the holding cost. We take the square root of the function. Now, there's a need to compute, therefore, at what point a firm should place an order for its next consignment once it's been able to determine its economic order quantity. First, it must know its lead time. Now, the lead time is the time between when an order is placed and when the order is actually delivered. The firm must also have a fair idea of its daily demand, meaning that the quantity of the product that is sold or used per day, and also its safety stock, which is the buffer, the level beyond which the firm does not want to fall. Now, putting all these together, therefore, the reorder point is the lead time multiplied by the daily demand that tells you how much should be in stock by the time you place the order, and then you add the safety stock. So where there's no safety stock, the reorder point is just the lead time, that's the number of days or period, multiplied by the periodic demand for that season. Now that brings us to the end of inventory management. There's more that we can glean by reading the relevant text assigned to the sessions. Now we begin to look at trade credits and payables management. Now, in the typical line of business, a firm may be forced to give credit in order to generate sales. So normally, an ability to find the right balance between how much sales can be generated given the amount of credit that could be offered is also very critical in facilitating the sales growth of every firm. Now, the options for offering credit may be that the business may issue a line of credit to customers, or sometimes in offering that it may offer credit and sell the accounts receivable to another firm at a discount to its original sales price. Now, the goal of accounts receivables management is to increase sales, typically by offering credit. But to be able to do that clearly or efficiently, a firm must have in place a credit policy. Now, this defines exactly, one, the terms of sale that would be given in terms of how it plans to sell its goods and services, and then to be able to determine who qualifies for credits in the first place, there should be a process of determining the probability that the customers will or will not pay, and this can be done using the 6 C's and other credit risk analytics. Then we also should have a collection policy. Now, this will capture the procedures to be followed by firms in collecting accounts receivables. Now, putting together a proper credit policy ensures that as much as possible, giving out credit finds the right balance with sales revenue generated and minimizes the incidence of bad debt. So now let's look at the credit terms. Now the credit terms can be written in the format of something like 2, 10, net 30. What it means is that the customer gets a 2% discount if payment is made within 10 days of invoicing. If not, the full amount is due 30 days from invoicing. Now, this begins to, and of course, to qualify to be given credit, we also look at the credit analysis. Now, this assesses the customer to ascertain their credit worthiness. In looking at the 6 C's as one of them, we look at the customer's character, whether a customer has over time been able to pay bills and whether there's a visible willingness to make payments in the near future. And also whether the customer has capacity in terms of their cash flow status or disposable income to pay back on the facility or the credit that is being extended. Now, sometimes there's a need to provide collateral. Will there be the collateral sufficient to be able to pay off the debt in the event of default? And also, is the capital, the net worth of the client able to repay the debt? And we can also look at the conditions within the environment of the clients to determine whether these may have any negative effects on the ability of the client to pay the debt, and whether changes in the legal environment could also adversely affect the debtor, for which reason payment may become a problem. Now, that's one way of determining the credit worthiness of a client, beyond which then the decision to either extend credit or withhold credit can be made. Now, in managing accounts receivable, one can use what we refer to as a collection days. Now, the collection days typically measures how long it takes a client to be able to collect on goods sold on credit. So if the client computes the collection days of existing customers and realizes that they are in excess of their documented credit days, then it means that the firm should be up and moving to be able to improve their collection period. Now, if on the other hand, collection days seem to be less than the terms provided in the firm's financial policy setting, then they have increased liquidity. They may consider loosening the credit policy in order to generate more sales. Now, another way to look at managing accounts receivable is to look at the aging of accounts receivables. Now, this tells which portion of the accounts receivable may receive a lot more attention because of the probability that they may go into default because they have taken too long. Now, this usually means that you draw up a template to look at how long some of the credit facilities have been outstanding, and the ones that have been outstanding for much longer will be focused upon for collection. And then based on how long proportions of the credits accounts receivable have been outstanding, then the firm can make the relevant policy moves to be able to arrest the situation. Accounts payable management, on the other hand, is more of the flip side, which is the trade credit from the side of a firm. As much as possible, accounts payable is supplier's credit and as such should be managed as such. Now, whilst it is much easier and tempting to want to withhold payments to suppliers, this could have negative implications for future sales and future dealings and may be considered unethical, for which reason firms are normally advised to make the most of it, extend it as much as practicable, but ensure that payment is done within time to ensure that in the future, business dealings with the suppliers are not unduly affected. So then we have, using the terms of payment, you can easily also determine the implications of foregoing cash discounts being offered by your suppliers. And if the cost of foregoing the discount is lower than available credit on the market or the interest rate on credit, then it is prudent that the firm borrows from the market to be able to take advantage of the discounts being offered. However, on the other hand, if the cost of taking the discount is so huge in terms of the fact that if you take the discount, you lose out, then there's no point in wanting to borrow to settle such a bill, because then it is cheaper credit on the side of your supplier. It is advisable that you take. Now, let me take a closer look at that again. So in this case where we have 210 net 30, in computing it, it comes to the point that we have a case of 36.7% annual interest if we were to delay the payment, meaning that we forgo the discount. Now, if you can borrow on the market for 20%, then it means that it is more sensible to borrow at 20% so that you can pay ahead of time. If not, if you delay, by delaying payments for the supplier and therefore losing the discount available, you intrinsically pay 36.7% more than you were due to pay if the discount had been taken. So that is relevant in making decisions on whether or not to take up a discount offer from your supplier or not. Now, this is the mathematical representation of what I just discussed, and that could be clearly defined and also used in relevant business decision making. Now, take notes to read the relevant chapters and also practice on the end of chapter questions for this session so as to improve your understanding of the course. Thank you and see you next time.